Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds, and this is a review of markets in October and a look forward as we approach the end of the year. Over the course of October, bond markets broadly stood still, with some changes in particular geographies. Clearly, the United States market did back up a little bit in expectation of the US election, but everyone is really waiting for these two very major moments, both domestically and offshore. Domestically, that is the extension of the RBA QE program and very likely a rate cut which we'll receive in November. And the markets want to know more information about this. It's been our expectation for a long, long time, as anyone that's followed will well know, that the RBA will do a lot of QE in the end, and it looks very, very likely that that will occur very shortly. And that will be by government edict, essentially, or RBA edict, to lower bond yields, to provide low borrowing costs for governments and states, get consumer borrowing rates down, but also to get the currency lower materially over time to make Australia more competitive. Now, the RBA have never wanted to do any of these policies. We know that. They've told us that incessantly, that they haven't wanted to cut rates or do QE, but they're being forced into it by virtue of the way that others are behaving around the world with their own central banking systems. And this exhaustion of monetary policy, where we now need to go on to new paradigms, and these really are new paradigms. QE programs the world over, once they have been enacted, have never been put back in the box. They do not end. So expect this to be a new policy tool for a long time yet, and it will really drive yields lower and hopefully push the currency down to help Australia become more competitive. So very, very powerful, particularly in our space, I guess, in solidifying future returns. The major moment for the end of the year, though, clearly is the US election. As we're recording this, it has taken place. It's a very frustrated process. We'd written about that a lot. We suggested that Trump would not leave the White House easily, and clearly that is going to be the case. He's going to run off to the Supreme Court, where the appointment of new conservative judges may very well help him. We'll have to wait and see. But the major thing in this that the markets maybe didn't quite focus on correctly was the construction of the Senate, whether the Senate would be very progressive or very moderate as to what policy would look like going forward. And it was our expectation that the Senate would actually be pretty moderate, and these huge fiscal programs which have been promised by Biden in a blue wave type outcome would be very unlikely to materialise. Clearly they'll come out of the House of Reps with some huge number for fiscal stimulus, but they would never get that number through the Senate. It would get watered down. And as we know, the Republicans are going to hold the Senate. And it looks like at this stage, Biden is probably the favourite to become president. And that's a terrible outcome for the US economy. It means that we're going to have a very frustrated and contested election. It means that any stimulus that would come to market will take a long time to get to market. And clearly, those Republican senators can be quite obstructive in terms of any kind of policy rollout that the Biden presidency might have otherwise enjoyed. This is crushing the reflation trade. I guess a lot of folks were getting excited about this huge amount of government borrowing that would occur in the United States, would start to foster up some kind of movement in inflation, and mainly in inflation expectations, to be honest. Actual inflation outcomes are horrible the world over at the moment. And we would expect that to continue to be the case in the short to medium term, as we've talked about a lot. But the market pricing now for inflation expectations has been absolutely crushed, because without this blue wave and all the power that would come with a multi-trillion dollar fiscal program, then clearly there's a much more restrictive type fiscal sustenance that will be provided, and those kind of structures will be tremendously challenged. Over the course of October, our funds generally had fairly mute returns. The market has been just treading water, waiting for these two big moments. But I do expect that there'll be some pretty powerful volatility and some pretty decent market moves coming towards the end of the year. The only exception to that was our global unhedged strategy, which was up over 1.75% as the Australian dollar started to depreciate. And as we said, under QE, we would fully expect that over the course of time that will continue to occur. Governor Lowe has been very explicit about wanting much lower bond yields and wanting much lower currency. And certainly over the course of time since QE has been enacted, you've wanted to go with your central bank. They are all powerful in the end. And the old saying in the markets is don't fight the Fed or whichever domestic central bank you might be talking about. And we certainly won't be trying to fight them too much either. They've come to this moment that they needed to come to. The next big phase of this, of course, will be negative interest rates. They've said they don't want to do it, just like they've said they've not wanted to do all of the things that they've now done. So we'll see in 2021, as the Bank of England, Bank of Canada, Reserve Bank of New Zealand are very likely to go to negative interest rates, and their own markets are pricing that right now. Again, it becomes a comparative thing. How do we get more policy sustenance into the Australian economy? That will be a debate for that time. But for now, it's going to be huge amounts of QE and a lower rate environment. Thank you very much.